My name is Karen Griffith-Graga, and I am Chief Investment Officer for DreamIt. Welcome to the DreamIt Athena discussion series. Today we have Sonia Nagar from Pritzker Ventures, who is joining us to talk about raising Series A. So Sonia, why don't we start a little bit just by you giving us an overview of your background.
Sure. So thank you for having me, Karen. Really excited to be here. I have a background in engineering, studied mechanical engineering at the University of Michigan, and then ended up doing a number of programming internships. So kind of fell into programming. Over my summers, I was working software internships with a company called Smith Industries Aerospace. And then after graduating Michigan, went to work for General Motors in their advanced engineering group, doing a mix of a little bit of tech programming as well as more mechanical engineering stuff. Decided pretty quickly that I didn't want to be a career engineer, so went to business school at Harvard. Then after business school, went to work for Amazon for a few years. And then after Amazon, I founded a company called Picky that was in the mobile shopping space. It was an app, and that was in 2012. Raised venture capital, had from institutional investors. TFJ Gotham led our round. And then 2 years later, we were acquired by RetailMeNot, which is a coupon marketplace that connects an audience of consumers to large retailers and their promotional content that's based out of Austin. So I spent the last 2 years in Austin running RetailMeNot's mobile team, and then kind of expanded my responsibilities every 3 months. CEO kind of give me a little bit bigger piece of the product team to own. And then just made the switch over to venture capital in January. So my husband and I wanted to move to the Midwest to be closer to family. So moved to Chicago, and I'm currently a vice president with Pritzker Group, which is a fairly large fund. It's a $7 billion fund in total that has 3 different arms: a venture capital team, a private equity team, and a fund of hedge funds. I'm on the venture capital side. We primarily invest across 4 verticals: consumer, enterprise, healthcare, and then we have a vertical called emerging, which is Internet of Things, artificial intelligence. Our mandate on the venture capital team is to invest $1 billion over the next 10 years, so trying to pace at around $100 million a year. And so our typical check size is $3 to $10 million. We like to come in at the Series A, lead, although we also will be part of syndicates and co-invest. And then one of the advantages to the Pritzker Group is that we have deep pockets, so we can participate in the Series B and onwards. I think the most we have invested in a single company is around a little over $50 million. So that's a little bit about myself and a little bit about Pritzker Group, which is where I'm currently investing today.
Awesome. Well, thank you, and thanks for sharing. What's your assessment of the current Series A fundraising environment? There's been some interesting dynamics taking place out there.
Yeah, so there's definitely a lot of noise, and I think in January, people thought that Series A funding environment was going to be dramatically different than it was last year. And the reason why people were saying that was because when you looked at the public markets and where companies were trading based on what revenue they were generating, multiples had come down pretty significantly. And ultimately, when that happens, valuations come down. And so as a result, you're seeing fewer IPOs, fewer exits. And so the hypothesis was that you're going to see some contraction in people's willingness to fund companies at the Series A level. Less so on the venture capital side. I think seasoned investors and venture capitalists have seen this story play out time and time again. I mean, this isn't a new, economies are cyclical, so things will ebb and flow. And, you know, we're still investing in great companies, and most companies are, most venture capital funds are all still investing in great companies, but where we expected to see more contraction or reduction was in non-traditional investors. So corporate investors might be less likely to jump in and invest, or people who maybe were less seasoned might be less inclined to invest. That said, I mean, from my perspective, we're still investing. We've done 3 or 4 deals already in the first quarter, larger size checks, as well as a number of seed deals. So I think that great companies will continue to get funded. I think what you're seeing is that it's a little bit harder, but it's always been hard if you've been in that middle category where you are doing well, but maybe not meeting all of the benchmarks or thresholds that we would expect a Series A company to hit. In that case, I think it's getting a little bit harder to raise funding, but there's a little bit of dramatization and doom and gloom that I think is unwarranted. Like, companies are still getting funded, Series A deals are still getting done. I think the IPO market is more impacted right now, which is way later than Series A.
Yeah, we always tell our entrepreneurs, focus on the fundamentals, because if the fundamentals are there, good companies will always get investment capital.
Absolutely.
So how do you advise entrepreneurs to prepare for the fundraising process, both kind of mentally as well as with their due diligence materials?
Yeah, absolutely. So one of the first things that I think is important to do when you're about to, actually months before you're about to go raise a round, is to develop relationships with investors. Mark Suster has a great article called Lines, Not Dots. The theme is Lines, Not Dots, which basically he talks about how he doesn't want to invest in people he's just met, especially when you're thinking about writing a $4, $5, $6 million check. You want to get to know an entrepreneur and know them over time and see that they have talked about what they were going to do, sold you on their vision, and then actually executed really well against that vision. I mean, it's fairly straightforward. You say you're going to do something and then you do it. And when you build a track record of having done that over time, that's how you build a strong relationship with an investor. So I advise people to get to know investors early, start talking to them well before, 6 months before you're ready to raise the Series A, and check in with them every 2 months. Like, don't be shy about sending an update email, just saying, hey, just want to let you know, we're on track with our plan. We said we were going to do this. We've actually exceeded plan. Those are the best emails to get. And then when you ask for the meeting, when it's time to raise your Series A, that investor has a lot of data points to say, like, this is why this company, I should make the time to A, take the meeting, and then B, hopefully after that meeting, represent this company to an investment committee. Because most venture capital firms are partnerships where it's not just a single partner making a decision. It's kind of like the partner or the vice president or whoever is coming to an investment committee and making a pitch. The other thing that I think is really important is knowing your numbers inside and out. When you come to raise a Series A, we expect you to come with data, and there's a little bit less of willingness to just take a leap of faith. So the seed stage, really easy to raise capital, and sometimes you can raise capital without having any data and just having a really great hypothesis and a narrative and a story and maybe very little data. At the Series A, we really want to see that you've figured things out. And when I say figure things out, I mean that you have proof of product market fit, so that people are buying your product or using your product. And then we want to see that the unit economics work if you're B2B or if you're a revenue generating company. So that means understanding your lifetime value for your customers, what your retention looks like, and what your cost of acquisition looks like. And ideally, we want to see that your lifetime value over, when you divide that by your cost of acquisition, is multiple greater than 1, ideally greater than 3, let's call it. So because what we're trying to get at, or we're trying to convince ourselves of, is that we can put money into this company and you know how to spend it, and that you can spend it effectively to scale your business. Because post Series A, it's all about scaling. We expect you to be well past the prove phase of proving out that there's a need for the product. And we really want to understand the scale phase. And then the last piece is we really want to be convinced that the market is very large. So ideally, we're moving away from the top down, the beauty industry is X billion dollars type numbers, and moving into more specifically what your addressable market is. So of the, $200 billion spent on apparel every year, how much are you actually going to be able to achieve? Like, and then that means either from a top-down perspective, getting down to more segmented analysis, or from a bottoms-up perspective, modeling out if you have a certain number of customers and they're spending a certain number of money, you know, how big do you think that can get?
So let's dissect kind of your responses to that question.
Mm-hmm.
So you think you want to start raising in 6 months. How do you reach out to the VC to start the conversation? And what's kind of, in your opinion, the best way to frame it?
So here, and there's been a lot, I guess I would stack rank the different ways that you can get to a venture capitalist. The best way is through a warm introduction from somebody that's in the VC's network. So an entrepreneur that has been funded by the company, that's a great way to come in. Another investor who's close with the VC, or even a friend of a friend. You know, you figure out on LinkedIn how you're connected and try to get the strongest warm introduction possible from somebody who can vouch for you and say, I believe in this business. And ideally, there's a short cover note that's got a couple of quick bullets, really short. I think one of the mistakes I've seen is people who will write a three-paragraph introduction is totally unnecessary. Like, I really just want 3 or 4 bullet points on, like, here's what I'm building, here's the data, like 3 interesting data points that will hopefully get my attention. You don't know somebody who knows somebody, so you can't get that intro. I think that the next best thing is to try and find VCs at events and give them your elevator pitch and try and meet with them. Or, and a lot of times the associates are the easiest path into a VC. So I know that there's some blog posts out there about how you should try and get to the partner right away, but, you know, associates can be a really great advocate and avenue, and at least from what I've seen, you know, associates can be incredibly influential in pitching companies and getting you in front of the right person at a fund. So that's another route. The things that I would say you should not do are cold emails, because it just shows that, you know, you couldn't, it's almost an indication that you didn't want to put the effort and the energy in to find a network connection or to attend an event where somebody from the fund is speaking or participating. And then LinkedIn is like the absolute worst. Like, I get a lot of LinkedIn cold emails, and it's like you couldn't even find my email or guess at my email. And yeah, that's just a lot. Those I just delete. I don't even read those.
And so do the entrepreneurs say, hey, I'm preparing for my Series A 6 months down the road. I just want to let you know what I'm doing and build a relationship, and be as direct as that?
Yeah, I think that's exactly the right message. I think they say you should ask for advice, and yes, sometimes you end up with funding. So I think if you can figure out other companies that the VC has invested in, or be a little bit targeted in how you approach the VC. So if you say, like, I see you've invested in 2 artificial intelligence companies, or you wrote this blog post, here's what I'm doing in the space, I think that's real, and I'd love to get your advice. That's a great way to make the conversation relevant and interesting. Yeah,
the saying is, if you go seeking money, you get advice. Mm-hmm. And if you go seeking advice, you get money. So
yeah. And then the side benefit can be sometimes when you have these conversations, you know, especially if a VC is interested, one of the things that you want to do is try and be as helpful and add value as you possibly can. And so there might be introductions that VC can make that could help you land your next customer, et cetera. So that's a very strong way to start building a relationship with a VC.
Mm-hmm. So let's break apart then some of these metrics that you're looking for on the Series A side. So you mentioned, you know, Pritzker focuses on consumer, healthcare, enterprise, as well as emerging. So if you could kind of break down those 4 categories and let me know some general guidelines on what you're looking for.
Yeah, and so I'm going to generalize across all 4. And I think that there are exceptions to, you know, it's really hard to give specific data goals because there's so many caveats and it depends type statements. That said, I mentioned one ratio that we look at, which is your lifetime value over your customer acquisition cost. And what that basically is looking at when I say lifetime value, what we care about is your contribution margin. So not your gross revenue, but your actual, how much you're making that hits your bottom line off of each customer. And then how many times they purchase over a year, and then how many years you think them to be active. That would give you a rough estimate of your lifetime value. Now, often when you're early, it's hard to know how long somebody's going to be active. So just assume a modest assumption of 2 or 3 years, and I think you'll be safe or fine. So that gives you your lifetime value, rough and dirty. And then what we want to look at is we'll divide that by your cost of acquisition. And when we're looking at your cost of acquisition, we want to look purely at your paid channels. So we don't want an average that includes your organic channels or your unpaid channels. We want to understand for the paid channels that you can control and scale up and down easily, what is your average cost of acquisition? So that ratio, your LTV over CAC ratio, we want to see over, I would say 2.5 or 3. So that's like a rough guideline. And basically that's a proxy for your unit economics. It gives us a sense for how efficient is this business. If we were to put $1 in, can we get, how much money can we get out? So that's one guideline. As far as minimum revenue requirements go, this is always a moving target. I think in general, the guidance that I was given when I was an entrepreneur, I'm going to revert back to that because I don't know that we have hard and fast rules here now, but was $1 million in annual recurring revenue for B2B. And I think similarly on the B2C side, if you've got over $1 million in revenue, that's a good data point that says, you're scaling. And then ideally we want to see pretty good month over month growth rates of let's call it 10, 20% plus. The higher those are, the better, the more attractive your business is going to look.
Okay.
So those are two on the growth side, and as well as on the unit economic side, 2 things to think about. And then there's a whole host of other things that we will look at and numbers that we expect you to know. So your retention rate, which is at the beginning of the year, looking at a cohort. Let's say you just look at the people you started with in January, what percentage of those people are still active in December? Also your payback period. So this is somewhat related, or it's another way of thinking about retention. But if you spend $50 to acquire a customer and you make $25 on your first sale, how long does it take until you have your second sale and you recoup your cost of acquisition? So is that 6 months before you see a person purchase a second time, and that's your payback period. Trying to think if there's any other big ones. I mean, obviously all of your financials, so understanding your revenue, your contribution margin, et cetera. But the things that I see people get stuck on are some of these retention and unit economics KPIs, where you should really know those numbers inside and out, because if you're not optimizing for those numbers, it kind of makes us question how you're optimizing your business or measuring success and figuring out what to build and what not to build.
So you kind of talked about this a little bit earlier with lifetime value. Even at the Series A, these companies are still pretty early stage, right? So some of their numbers are one eye closed and, kind of eyeballing it a little bit, even with, the customer acquisition costs and so forth. What's your advice relative to, having assumptions around these numbers and how you kind of support them and justify them?
I think to a certain extent, nobody's going to know your business like you know your business, but ideally you have some data. So like I said, a simplifying assumption for your lifetime, like how long a customer will be active in the consumer space, might be 3 years. So feel free to make a simplifying assumption and then just be willing to back it up. And if the VC doesn't believe that assumption, on the back end, the associate, when they're doing the analysis on whether they think your deal makes sense or not, is just going to correct it. So I think it's just important to pick a number in some ways and have some rationale that you feel good about, that you can defend, and communicate it with confidence.
Well, and I think an important point about that is also sensitivity analysis, right? Knowing you are going in with these assumptions because the company is early, but you want to do kind of sensitivity analysis to know the boundaries of things, of where they actually break, and having kind of a scenario to prevent that from happening, or at least address it when it happens.
Right.
Okay, great. So what about defining the proper amount of capital to raise? How do you think entrepreneurs should approach that?
So there are a couple of ways to triangulate that. I mean, I think the most important is you need to figure out what you need to grow the business, and that will imply a monthly burn rate, and that you want to make sure that you're raising enough for 18 months of runway. So that's like a bottoms up way to look at how much capital you should raise. Now, another way to look at how much capital you should raise is if you have and you're able to successfully generate a lot of competition for your deal, one thing that happens is your valuation gets bumped up. And when your valuation gets bumped up, a VC is going to expect to take 20 to 30% of the company in any round of funding, Series A especially when you're raising from a fund like a Pritzker Group or any of the larger funds. And so that you can use that number to back into how much money you can raise, which is if you know you've got to give up 20 to 30% of your company, bump up your valuation, and maybe you're raising more than 18 months runway because you can. And that's where you see people like Pinterest, when they've had to raise later rounds, they've ended up with these massive mega rounds because their valuation was so high. And so in order to raise any money, they couldn't just raise 2 million or 3 million. They needed to raise a much larger round and scale up their ambitions for growth probably as well.
So there is a lot of sensitivity often on the part of entrepreneurs relative to valuation and how much dilution they're going to experience relative to the amount of capital and the valuation. A lot of debate out there. I think it's a risk profile thing, right, for the entrepreneurs. But what's kind of your thinking about how to approach that balance?
Yeah, I mean, you can assume that in every round, you're going to take 20 to 30% dilution. And the thing that will dictate how much dilution you have to take is the number of investors that are interested in your deal, and it's market dynamics at play. So if you have more people that are interested, you can negotiate a higher valuation and lower dilution. If you don't, then, that's what the market will bear. So unfortunately, I think ideally you're negotiating the least amount of dilution, but at the same time you want to bring on the right partners. So you got to think about a lot of factors, and it's totally a personal decision on the entrepreneur CEO's part to say, this is the amount of dilution I'm willing to take. These are the terms that the market's willing to offer. If I have 3 term sheets and maybe one of the term sheets is from a fund that wants to dilute me more but has the right relationships or the right network of other CEOs in the portfolio that I want to get access to, then maybe you're willing to take more or less. So it's going to be a case-by-case decision you have to make, but in general, 20 to 30% dilution is a pretty standard range.
So I typically advise the entrepreneurs, if more is available, you take it. Because in 99.9% of the cases, it takes more capital and a longer time period to achieve the milestones. Has that been your experience as well?
I 100% agree with that advice. It always takes longer, and the worst position that you can put yourself in as a CEO in a company is to be running out of cash.
Yeah,
because that's when you end up really giving up, taking on dilution and giving up more of the company than you want to on really crummy terms. So avoid that at all costs. Having cash and runway in the bank, it gives you negotiating leverage.
So what's your thinking on, so say a company is trying to raise a 5 million Series A. How many funding groups do you think they should mentally prepare to approach relative to that funding?
So this is a really interesting question. I have heard from entrepreneurs that we funded or entrepreneurs just in the community that I've worked with that the answer will range very greatly. So there was one woman I spoke with who had a really targeted approach and was successful with this very targeted approach where she had done the research to figure out, given the space she was in, who would invest. And granted, she was building an HR technology company that was kind of in a niche. And so she knew that there were just certain investors and funds that were not going to be interested in the things she was building. And so she whittled down her list to about 12 or 13 people, ran her process, and was successful in getting at least one. And all you need is one person to write a check. I think that's hard, and that's probably that's an extreme. I don't think it would be atypical to have a very large funnel where you reach out and do initial meetings with 25 plus, 30 plus funds. But the more pre-work you can do to qualify your leads, it's like running a sales process where you have a funnel and you want to have highly qualified leads. And if you can do a little bit of work to pre-qualify your leads and not spend a ton of time doing in-depth meetings with people who are not going to be interested, that's just better use of your time. And your time is immutable. It's, a resource that cannot be replenished easily. And it's when you're fundraising, that's time that you're taking away from the company. And I mean, it's not atypical. We see all the time that people will go into fundraising mode and the revenue and the growth and all the traction kind of plateaus for the 3 or 4 months that they're on the road. The CEO is on the road trying to raise funding, so that anything you can do to shorten that is highly advised. So, but I think doing the work to pre-qualify and build relationships slowly over time so that when it comes time to raise, you have your 20 targets is probably the best thing to do. But there's no magic number. It's really, again, if you're a hot company and everybody's coming to you, maybe you only have to do 3 meetings.
That's a very low percentage of companies. I tell my entrepreneurs, and I agree 100% with your pre-qualification statement, to mentally prepare to have 100 conversations. Because to me, fundraising is like finding product market fit. You often, have to have quick initial conversations to do that qualification. And, to me, 100 seems to be a good number, just even to mentally prepare.
Yeah, and I think at the seed stage, that's definitely true because you have a larger, broader group of people, angels, seed funds, that are all playing in alongside institutional investors or Series A, B investors. At the Series A stage, I would hope that you could be more targeted, but it may not be the case, especially if you want to hit multiple geographies, and do your New York, East Coast, West Coast, Midwest trips to meet up with a bunch of different funds.
So how do you suggest pre-qualifying the Series A investors beyond looking at their portfolio and see if if they're interested in your space and your type of business model? What do you suggest beyond that?
Well, ideally, you've started at the seed stage. Like if there are funds you talked to at the seed stage that were interested, but you were too early, those are people to keep on your list. And ideally, it's the same. So you're looking at people's blog posts, people's what they're putting out there, in addition to what companies they've invested in. So figuring out, who's invested in your sector, your space. Crunchbase can probably be a great resource for this. And then create your hit list. And then for the pre-qualification, it's the trying to build your lines versus just being a dot on somebody's radar by scheduling a coffee chat or a meeting in the 6 months leading up to your Series A, and then gauging their interest in that meeting to see if there's a fit. So you're probably going to have some people who feel really warm, some people who feel kind of cold, and so prioritize accordingly. And it may not be a bad strategy to start off pitching with 1 or 2 people who you think might have a low likelihood of closing, just to get either feedback on your pitch, see where the holes are, see where they ask questions, or see where you lose them, if you notice that you lose them at a certain point in the pitch, and ask for candid feedback so that you're warmed up for the people who you think you have a higher likelihood of closing.
So ideally for the Series A, you almost start 6 to 8 months beforehand.
Absolutely.
Do you kind of have a rule of thumb as to what percentage of time entrepreneurs should be kind of dedicating to warming up the investor base 6 to 8 months out, given the fact that they're trying to build the business and drive the metrics that they need to achieve?
Yeah, I don't know that I have a percentage of time, because I think that the quality of the time matters a lot more than the quantity of the time. But I would say if you can because investors are busy, so it doesn't need to be high touch. It could be an email that you send. So you do one upfront meeting that's like a 30-minute, 45-minute, here's who I am, here's my company, and then follow up and be consistent. So once a month or once every 2 months, send an email. I mean, it doesn't have to be an in-person meeting. Emails scale great. So, and for a VC, like, they don't necessarily want to be sitting down with you every single month unless they can add value or there's something specific that you need that they can do for you. So email is a great scalable way to just maintain that contact. And you can send the same email to everybody, although personalized email always is a nice touch.
Right. So let's shift gears a little bit. So, an entrepreneur is in full Series A fundraising mode. They've met with a VC, a Series A VC. It seems to go well. And now the VC is not responding at all to the follow-up. Mm-hmm. What's your guidance there?
Yeah, so the thing to understand about VCs is most decisions get made on Mondays. So if you're off cycle, like if you miss the Monday and you present on a Tuesday, they may have to wait. There's also sometimes competing demands if they've got other big deals going on. So sometimes I wouldn't read too much into it, although for the deals that people are really excited about, they tend to push through pretty quickly. So it's not a great sign if the VC isn't responding. There's no harm in following up, though. So follow up for a response. I think that most of the VCs that I've talked with want to be responsive because they recognize, hopefully they recognize, or maybe, I don't know, I definitely realize, having been an entrepreneur, that the most important thing is, like, you want timely feedback. So don't be afraid to follow up, just in case there is something weird where, they got pulled onto another deal, and so they're behind on emails or haven't gotten a chance to follow up. But then I also think that so you can ask, do they need more data? Do they have information? Is there something that's specific that's concerning them? Like, maybe they are really excited, but weren't convinced that the market size was big enough. And so there's a customer call you can set them up with to help push them over the edge. And then leverage your network. If you have people in your network that are connected to the fund, don't be afraid to get back channel feedback on where people are. So that's kind of another tool you have in your toolkit, is either investors or people you've met through the community, other entrepreneurs that can try and push the process along.
So what do you think about directly asking the question? In the sense that I know I personally am drowning under email, so I tell people, follow up with me 2 or 3 times. You'll hear back from me eventually, but
yeah,
there's a lot going on.
I think that's option number 1, is following up directly, asking them, do they need more information? Do they need more data? And then the next best thing is to have other people back channel to try and push them forward.
Yeah. So structurally, there's a lot of bells and whistles with preferred rounds beyond valuation and amount of capital that we've discussed, liquidation preferences, dividends, anti-dilution, board roles, and so forth. What advice do you have for the entrepreneurs on how they need to think overall structurally about their rounds?
Yeah, I think here my advice is pretty simple, which is to hire a good lawyer, because you realistically, and this is how I felt as an entrepreneur, and the advice I got from my investors was, or my angel investors who were a little bit more aligned than the larger funds, is you're going to see 1 or 2 term sheets, and venture capitalists work with hundreds of term sheets. And so I just would expect that you're going to want great counsel, which will come in the form of a lawyer who has seen hundreds, if not thousands, of term sheets before to give you advice on all the weird nuances that people can put into a term sheet. But yeah, I mean, my advice there is really hire a great lawyer, read venture deals so you have at least a working knowledge of what all the terms are, but hire a good lawyer to give you the advice.
And what about pushing around towards closure, right? You have people that are in due diligence, seems like you have some, a potential lead, some soft circles, how do you drive around to closure?
Right, so the best thing you can do is create competition. So if you have one person that comes to closure, then everybody else has to also, or they lose the deal. So the best thing you can do is have competition.
Okay. Let's see. Is there any advice that you have specifically for female founders in the fundraising process?
I mean, my advice for female founders is the same as advice that I give male founders, which is just, have confidence when you're pitching. Make sure you nail your narrative, like have a good story around why you are the best person to be going after whatever it is that you're building, and then know your numbers. I'm surprised at how many times an entrepreneur will come in and will ask questions about their unit economics or how their basic business model works. And, there's I think that's one of the worst things that can happen is you don't know your numbers or you don't have confidence around your numbers. So just make sure you know your numbers, especially at the Series A stage.
So if you don't know an answer, is that a killer to the deal?
If it's something that we think should be obvious that you should be optimizing for in the way you run your business, then it is. Yeah, it can be a killer to a deal. I think if you don't know a number and want to verify a calculation, it's totally fine to say, let me come back to you with that, and then come back very quickly after the meeting with it. But there are certain basic LTV or CAC ratios, some of those ratios that, if you're not using that to optimize how you're spending your marketing money, then I kind of wonder how you're going to manage, how you've been managing the business, how you'll manage the business going forward.
Okay.
Excuse me, Karen, I'm sorry to interrupt. I just noticed that we're about 20 minutes until the end. I just thought maybe you want to take the opportunity to ask our cohorts if there are any of the female founders that have any questions, they could raise their hands, or if anyone else has any questions, they can raise their hands and we can bring them up front. And if not, we'll just allow you to continue with your conversation till the top of the hour.
Absolutely. So does anyone have any questions? We're happy to offer up Sonia to give her perspective from both an entrepreneur and a venture perspective. So Doug, are you seeing anybody?
Yeah, Karen, just keep going with it. If I have them, I'll bring them up.
Okay, that sounds good. So, both of us realize, right, that raising capital for female founders is a different exercise in general than for male founders. It just by the law of numbers, right? Are there specific do and don'ts that you see for female founders?
Yeah, I mean, I think that I love the fact that there's so much transparency and discussion around some of the experiences women have had in fundraising, be it positive or negative. That said, I also feel like it's done a disservice a little bit to people will get in their own heads so for me, all of my investors were male. And there are a lot of great male investors out there, and there are a lot of great female investors out there. And I think that there is a recognition in the venture capital industry that there should be more female investors out there. And I think I'm, one example and part of a trend of funds bringing on women as investors. So I think my biggest advice is not to go in assuming bad intentions, because you're only going to diminish your own performance. And I think that in general, maybe I'm an optimist, but I think most entrepreneurs are optimists because we go into a situation where, you want to defy the odds and you believe you can defy the odds. Just don't overthink it, assume good intentions, and prepare. Do your best.
Okay, sounds good. So I do have a question that's come in that is, I think a little bit related to a question we asked earlier, but I'll ask it again. So we have a company in our cohort that's a technology-enabled service, and they're looking for guidance on, what typically a Series A is looking for in terms of ARR, right? And you had indicated earlier $1 million figure.
Yeah.
Do you want to expand upon that?
Sure. I mean, I think that's a good minimum bar. I think what we want to see is that not only you're hitting that ARR, but you've got reasonable growth and reasonable unit economics. So the top line number matters. The way that you're achieving growth also matters, would be my thought there. And then another small tip for tech-enabled services or services that are enabled by tech is one thing that I've noticed as we've been getting pitched by a lot of services companies that are tech-enabled is that we have a definite preference for folks that are tech companies first and services companies second, and are figuring out ways that they can diminish the amount of manual work that's part of their service, and you're really using technology to create a competitive advantage. So it's just something to think about as you're positioning yourself for investors is we want to know that your business can scale, and services businesses tend to scale linearly, whereas tech businesses have a multiplier where they can scale way more efficiently. And so when you're pitching venture capitalists, especially tech investors, emphasizing the technology you're building will be a really important part of having a successful Series A conversation.
So what advice do you have for companies that are tech companies that have a hardware component? And oftentimes with this hardware component, they need to raise capital to build the hardware to prove out the solution and the need. So it's a bit of a chicken and egg problem. So what's your advice there?
It seems like the strategy a lot of hardware companies are taking is to pre-sell. So take pre-orders either via Kickstarter, or if you do it yourself and not give Kickstarter a cut, that's great too. But you want to have some data that you can provide. So it's not a leap of faith to fund something that has a heavy hardware component.
And what about the healthcare side? Oftentimes there's studies and so forth that are needed to validate.
I am less familiar with the healthcare device hardware side of things. That's just not an area that our fund invests in. We're healthcare IT, but not devices. So I don't know that I could speak to that.
Okay.
Give good advice on that. Be the blind leading the blind on that one.
So kind of back to, you have this emerging component of your portfolio. And you kind of mentioned that you do seed sometimes. Could you expand upon that portion of your portfolio?
Sure. So at the seed stage, we're focused on 3 geographies: New York, Chicago, and LA. Our focus is really on the Series A. So this year especially, we're doing a lot less investing there. But what I'm noticing is that the funds that we are, or the companies that we are funding are just, entrepreneurs where we want to get to know them and have a strong thesis in whatever it is that they're going after. So for example, artificial intelligence is an area where we've made some seed investments or some investments, and it's an area we want to learn more about. And so, that's a place where we were willing to put in a smaller check. But in general, we're really trying to focus on the Series A. Okay.
So I know you're trying to focus on the Series A, but let's pull into your previous entrepreneurial experience where you raised a seed stage round. What advice do you have on the seed stage process from your entrepreneurial experience versus the Series A?
Yeah, so at the seed stage, there are a lot of common tactics that we use to raise our Series A. So we had done an accelerator program, Techstars New York, And through that program, over the course of 3 months, had built relationships with investors and entrepreneurs and angel investors, as well as seed funds. And we kind of did exactly what I talked through, which is we built relationships with people over time. We sent them updates on the progress we were making bi-weekly, I believe, during the program. And then after the program, we switched to monthly. So there were a lot of people who knew who we were. And I think that at the seed stage, what matters a lot more is your team and your narrative, because that's really what people are making the bet on, because they know you're going to pivot and change. And so I had built a really strong team. So it demonstrated that I could bring on really strong technical co-founders, as well as hire the right people. And then I think we had a strong vision and an interesting narrative that got people excited.
And so the best advice for refining the narrative?
I think that it's got to be authentic to you as a person, and something that only you uniquely, like, it can't be, if I said I was going to create an ice cream e-commerce site, I have no background in e-commerce. I have no, experience or passion or nothing demonstrated that I could point to that would indicate that I would be the ideal fast founder to go after this space. So I think that's kind of like a test. It's like a stress test you can put your narrative through. It's like, is this unique to me? And is this something that, like, I have an authentic advantage in? And does this convey that I have this authentic advantage? That's kind of like the test.
Okay. All right. Sounds good. Well, I think we're running out of time. So do you have any kind of last minute advice that you want to share with our Dream at Athena founders?
Yeah, no, I mean, I think we covered a lot of ground in the last 45 minutes to an hour. And, I'm always happy to help fellow female founders out. So if there's anything I can do to help specific companies, let me know. Don't be shy about reaching out. They can get to me through you. So have a warm intro. Everybody at Dream It has that. So let me know.
Absolutely. Well, thank you so much for your time. We really appreciate it.
Thank you, Karen.
Okay.
All right.
Bye.
Talk soon. Bye.
Bye.